Hello and welcome to another edition of GQG's 7-Minute Alpha. My name is Ted Yo. I'm a sales director for the intermediary team. I'll be your host today. I'm joined by my colleague in the UK and client portfolio manager, Jonathan Miller. Today our topic, a panda's pace, is one that we get questions from both institutional and wealth management clients across the world. And that is, what is the current state of investing in the country of China? We'll provide you GQG's perspective as it relates to their latest stimulus, the effects that had, as well as tariffs and a potential trade war with the US. And are we looking at it from our perspective saying, okay, China historically has been a high growth economy, but maybe not so much anymore. Maybe their future is a slower, steadier panda's pace. I'm going to pass it over to my colleague, Jonathan, and he's going to help illuminate for you all what GQG's perspective is as it relates to portfolios and positioning. Jonathan?
Thank you, Ted, and thank you to everyone for joining us. You're right, there's been a lot of headlines around China, so let's delve straight into our views and how we've reacted. If you start by casting your mind back, it was in late September, just a few days before the Golden Holiday Week, when Chinese authorities announced measures to try and stimulate the flagging economy. I'd highlight a few key things that were brought to the table. Firstly, reducing interest rates. Secondly, cutting mortgage rates and easing rules for second property purchases. Then also giving banks and financial institutions access to liquidity to then buy stocks. We saw a sharp rally in the Chinese market off the back of this. Broadly speaking, our take on these reforms is they've not yet done enough to revive the economy. For us, when we look around, consumer confidence is still low, the government can intervene in the private sector, and the property overhang is massive. According to a number of research firms, there's 90 million properties that are either empty or unfinished. In our mind, this is crucial, as the sale of land and development are the key mechanism for local governments to raise capital. It's 30% plus of their revenue pot. So the slowdown affects their ability to fill their coffers and fund regional spending. We've seen things like late payment to medical staff in public hospitals, retired city employees not having pensions paid, and worker protests. We believe that to try and turn this around, to get things moving quicker than a panda's pace, it'll require a bazooka stimulus to stabilize, then restart the system. All this means we continue to have a large underweight to China in our portfolios. We didn't buy into the euphoria that sparked the rally, but let's also not forget that since the end of the first week of October, we've actually seen a large pullback. Where we do have exposure, we've got some positions in China. It's still mainly in state-owned enterprises within financials and the energy sectors. Because really, we're more comfortable being in companies that are aligned with the government rather than in the private sector.
So in line with those talking points, Jonathan, we have a new US president taking office on January 20th. With tariffs firmly on the table, what does that mean from our perspective?
Yes, and one of the first things Donald Trump laid out was a desire to impose tariffs. He's also brought Mexico and Canada into the mix. If you add China to those two countries, all three combined account for nearly 45% of all goods imported to the US. For countries closer to home, the Mexico and the Canada part, we'll have to wait and see the extent of the political posturing around all this, as in politics, the bark is often bigger than the bite. But coming back to China, we've got a graph here that shows the value of US imports from China in blue. That's going back to the early 90s. There's then the tariff revenue in the orange bars. And you can see by the orange bars that tariffs on Chinese goods already existed before Donald Trump came to office the first time around. Now, if you look towards the right-hand side, under Trump's tenure, the value of goods imported from China reduced. That's the blue bar getting smaller, given the increase in tariffs. And that was the aim, protectionism rather than a tax grab. It's worth adding that roughly 40% of US imports from China didn't receive US tariffs, and these were mainly consumer-led goods. We can also take this further and examine how different sectors of the US market performed in the aftermath of tariffs being implemented during Trump's last tenure. On this new graph, bars to the right made positive returns, with utilities and telecoms at the top, while the worst affected at the bottom were semiconductors and China-related names. Of course, today the narrative is around an even tighter control on semiconductors, chips, and not letting China gain any advantage in AI. Part of Trump's aim is to also force companies to build chips domestically. But if you look around the world, demand on a global level for chips and semiconductors is still high. We've also got inflation, which wasn't around back then. At the same time, it's worth also remembering this isn't one-way traffic. China also has ways to control its destiny and is countered by banning exports to the US of a number of minerals used in semiconductors, infrared technologies, and electric vehicle batteries. So we shouldn't be surprised to see a lot more toing and froing from here.
That's really helpful, Jonathan, on how our landscape could look. GQG prides itself on its adaptability. So what does that mean for positioning today?
I'll start by saying there's always noise and jostling in politics, but one thing's clear, and that is there's a global AI race. Whether what happens in markets is akin to the graph you saw from last time around in 2018, 2019 is more of a wait and see. Now, when it comes to policy changes, tariff implementation, or the extent of any further stimulus we might see in China, we stick to our process. This means assessing the impact on earnings growth, observing new data points, and adapting our portfolios to reflect new information. So as we look into 2025, we'll continue to go to where we see fundamentals improving. We're seeing a number of opportunities actually in areas where you get a mix of steady earnings growth and a decent dividend yield. Right now, we believe owning some of those steady eddies is more valuable than potential cyclical upside we may or may not get elsewhere. And we feel that's important to be mindful of this, as it can help with downside protection if markets indeed do get choppy from here.
Thanks, Jonathan. This has been really insightful. And thank all of you for joining us today for our latest GQG 7-Minute Alpha. We hope you enjoyed a panda's pace. If you have additional questions regarding investing in China or our other investment strategies, please don't hesitate to reach out to our client relations team directly. Thank you all again. Have a great day.